Hi, good afternoon, everyone. We're living in volatile times, so equity is not just an asset class today. It's a story of conviction, and it's a gateway to wealth creation. So let's try to decode this story together. Firstly, I'd like to start with a macro backdrop. Where do we stand currently in terms of the overall macroeconomic outlook for India? Number one, we look at the inflation figures. The inflation is currently inching just below the lower threshold that the target RBI has set. It's 4% plus minus 2%. We are inching downwards. And with the recent cut in GST, I think this number is likely to remain lower or further down from here as well. Secondly, we look at the fiscal deficit where we are headed. I think India is the only country among all the major economies that have significantly reduced its fiscal deficit in the last 5 years, and with the big RBI dividend bonanza as well as lower oil prices, I think this number is likely to inch downwards to almost 4.4% by end of this financial year. Lastly, when we look at the overall CapEx spends by the central government, it's been significantly higher. It's up 54% on a year-on-year basis in the first 2 months. When we look at the historical data, if you can look at the chart on the bottom right hand side, I think such a significant amount of capex spends in the first 2 months, which is almost 20% of the annual target, has not happened in the last decade. So government is serious about pushing this capex spends and driving the economy. Then we start to peel the second layer, which is the corporate India. Are we ready to roll? When we look at the current balance sheets of all the listed as well as unlisted entities, we see that the debt equity ratios are significantly low. They are at a cyclical low of around 0.5x. This is almost a 10-year low number, and the sector has seen a lot of challenges. Like in the last decade, there has been the implementation of the IBC Act. We've gone through tough times in DHFL, ILFS, all the typicals that went through. Additionally, when we look at the current market cap to GDP ratio of India, it's somewhere close to 1.45 times. So the corporates can actually start re-leveraging their balance sheet, as well as they have easy access to capital. By diluting a minimal portion of your equity, you can actually raise capital at very low cost today. On the right hand side, when we look at the capacity utilization, like why would a corporate go out and spend money? When we look at the capacity utilization data published by RBI, it's actually inching upwards of 75%. That's the threshold level where actually the newest capacities start coming in. To support, when we look at the manufacturing data, that is the PMI, is also remaining strong parallelly, which all the more drives the need for fresh capex and capacity expansion. But this would not happen without consumption. So we look at two important data points to see where urban as well as rural consumption is headed. On the urban consumption side, what we've tried to do is we populated the entire employee cost of all the listed, unlisted as well as government entities into one chart, and that number tends to be somewhere close to 53 lakh crore today. If you look at the growth in this number in the last 3 to 4 years, it has been increasing at an average rate of 4 to 4.5 lakh crores per annum. But in the next 2 years, we're going to see a significant rise in this number, essentially because of the 8th pay commission coming in. So if you look at the overall employee cost today of this 53 lakh crore, roughly 50% of this is central, state as well as PSU employees who are going to see a big bump up in their salaries. That's going to drive an additional increase of anywhere between 6 to 7 lakh crores over and above the nominal 4.5 lakh crores that we see every year. So in the next 2 years, we're going to see an average increase of somewhere between 7 to 8 lakh crores per annum, which will be significantly higher than the usual trend, and that money is going to get funneled into consumption. On the right hand side, when you look at the rural spends, actually this will be first time in the last 5 years, you will actually see a real rural wage growth. The inflation was much higher than rural wage growth in the last 5 years, but in FY26, we've seen an inflation which is significantly lower. We've seen monsoons which are above normal, as as well as we've seen the rural economy is going to go out and spend because the MSP price increases are going to continue to sustain. So we're going to see a real rural wage growth in FY26. Then we look at the third layer, which is where the domestic risk capital is headed. If you look at the SIP data, it is actually sustained at that 28,000 crore plus number consistently for the last 6 months, even in the backdrop of all the bad noise, like in terms of FII sell-off, the India-Pak conflict that happened, as well as the high tariffs that were imposed on India. The SIP number continued to remain strong. As well as on the discretionary side, we've seen the equity inflows. They've seen a strong bounce back in the month of July. And with the recent announcements around GST cuts, we think these is going to accelerate. So there were 3 major cuts that have happened in 2025, which will drive this consumption in our view. Very first started with the budget, where government cut the income tax rates. Our estimates suggest that somewhere around a benefit of 97,000 crores to 1 lakh crore would be capitalized by more than 2 crore taxpayers. But if you look at the chart on the top left hand side, bulk of this will be captured by taxpayers in the 8 lakh to 20 lakh bracket. So where are these consumers going to spend? They are not going to spend in the low ticket consumer staple items. They are going to spend in apparels, consumer durables, two-wheelers, travel and tourism. Those are the sectors where a lot of this money will get funneled into. If you look at the monetary policy action from the RBI side, I think there has been a significant rate cut in repo of about 100 basis points over the last 6 months, as well as there has been a CRR cut. Now when we look at the total retail credit in India, it's somewhere about 100 lakh crores. A 1 percentage point cut would put additional 1 lakh crore into these borrowers' pockets, which they will be okay to go out and spend further. And lastly, the news which we heard last week, it was unprecedented that a GST cut announcement was announced much before the actual cut happened. While there may be some lag of 1.5 months while it's actually implemented, but eradication of the 2 major slabs, that's 12% and 28%, would actually put a lot more money into consumers' pockets in terms of tax savings. Various estimates suggest it is somewhere between, let's say, 90,000 crores to 1.5 lakh crores. Let's say the midpoint is 1.2 lakh crores, is going to lead to a cumulative benefit of more than 3 lakh crores with the tax cuts, with the income tax rate cut, repo rate cut, and the GST cut into consumers' pockets. So this is the money that we think is going to get funneled into consumption over the next 6 months to a year. So where do we invest? The strategy that we are following and suggesting investors at this point in time is mid-caps is the space to be in. We think the narrative of big getting bigger, flight to safety, act defensive, I think it's not going to work out in the next 6 months to a year. Precisely, I'll give you 3 reasons for that. The very first is when you look at the large cap earnings, they are actually increasing at a much slower rate. Over the last 4 to 8 quarters, if you look at the earnings growth by large caps, they are actually in single digits. We've seen big cuts in the Nifty 50 index earnings over the last 4 quarters. Secondly, if you look at the large cap earnings as a percentage of total profits, that's actually coming down. The main reason is all the larger sectors, be it big pharma, big IT, consumer staples, they are facing competition from nimble-footed, smaller and mid-sized companies which are outpacing them, and that is likely to continue in our view. Secondly, when we look at the multiples, the headline number that everybody gives is Nifty trading at about 19 times, 20 times. These are on FY27 at 18.5 times today, much more cheaper as compared to the Nifty mid-cap index. But when we look at it in contrast to the earnings growth and the PEG ratio, we see that Nifty 50 is actually 20% more expensive than the Nifty mid-cap index, because the mid-cap earnings are likely to grow at a 15% CAGR versus a 10% CAGR for the large cap stocks. Secondly, when we look at the composition for Nifty 50, these are the 4 sectors which trade on a consistent basis at a low PE valuation. So 52% of the index is trading at a valuation of somewhere between 14 to 14.5 times PE ratio, which suppresses the overall Nifty's PE to 18.5 times. If we adjust, you will actually realize that the Nifty's PE ratio is somewhere around 23 to 24 times, which is in line with the mid-cap index, while the weight of these similar sectors in Nifty mid-cap is just about 20%. So to that extent, we are not comparing apples to apples. Also, the third point, most importantly, when we are investing in the broader large cap Nifty 50 index, are we actually participating through sectors which will drive future GDP growth? There are a lot of sectors today which are growing much faster and they're not part of the Nifty 50 index. That's chemicals, hospitality, auto anchs, capital goods. They are significantly underrepresented in the Nifty 50 index, and we think some of these sectors will be future growth drivers of the GDP, and the only way to participate is through a mid-cap stock index. Also, when we look at the earnings trajectory, as you can observe in the table above on the right hand side, the number of companies which are consistently being able to grow more than 15% CAGR is actually coming down. There were more than 60-70 companies 8 quarters back which were growing at 15% plus CAGR. Now there are a handful of companies that are growing, not more than 50 companies which are growing at this rate. So what does this tell you? This tells you that the growth is getting concentrated in few mid-cap stocks. So buying a broader index or diversifying your portfolio into 70-80 companies kind of a fund would actually not give you returns. You have to be more selective, and we think that this is going to be a stock pickers market at least from the next 6 to 12 months perspective, because earnings are going to get more and more concentrated between these fewer stocks. And as we see the returns historically, the returns in the mid cap and the small cap index have been significantly higher than the large cap index. So where do we invest and where do we go from here? The key question in everybody's mind, which are the right sectors to invest in? Firstly, we are quite positive on the entire power equipment sector. I think power prices have been coming down. The renewable energy sources, especially solar, the power generation rates have been down by about 70%. But can they meet the evening peak demand rates? No, they cannot. So we still need some amount of thermal power to continue to drive our power generation requirement. And that means very few companies today are left which can continue to supply this power generation equipment. And it's not a scarcity of power just in India. We are facing a global scarcity of power. A lot of companies in US are making heavy investments on the AI and data center side. Now we have some select companies in India which are able to supply equipment to these companies as well. So the entire power generation space is seeing a big demand supply kind of a mismatch, which I think the investors can capitalize on. Also, the another leg to it is on the transmission side. Because so much power is getting generated through renewable energy sources, a lot of this is getting concentrated in certain regions. And to evacuate this power, you need high voltage DC lines, which very few companies today are adept with the technology. So the investments in this space, I think, is going to do well purely because of the demand supply mismatch that we're likely to see, at least for the foreseeable 4 to 5 years. Second space where we are quite bullish is the consumption space. As I mentioned, because of the tax cuts, the interest rate cut, as well as the GST rate cut that is going to get implemented, a lot of money is going to be left into consumers' pockets. And they're going to spend this money on small to mid-ticket kind of a consumer items like consumer durables, apparels, travel and tourism, and a lot of online spends as well. So we look at the retail penetration rate today, and that's the best way to play the story. We have large retail companies listed in the space of apparels as well as gold, consumer durables, where investors can actually capitalize on this trend, as well as a trend where a lot of shift is happening from unorganized to the organized sector. So you look at the chart on the bottom right hand side, those are the spaces where today retail penetration continues to remain low. And as these companies are proliferating into tier 2, tier 3 towns, a lot of these companies will grow bigger in size and will present a good opportunity to invest in. The third sector where we are quite bullish is the healthcare space. This has two parts to it. If you look at the charts on the left hand side, it's the CDMO space where cost of CDMO companies in India is actually 40% of what it is in the US today. The salary that you pay to a scientist in US today for research work is somewhere about $75,000 odd. And the same value in India is somewhere between $25,000 to $30,000. So you're significantly cheaper in terms of the overall cost that you pay to an Indian scientist as well as the research activity that you do. Also, on the right hand side when you look at the charts, the hospital beds per 10,000 population is one of the lowest that India has today at 1.5 per 10,000. And all the current listed hospitals have significantly higher expansion plans. When we look at the RPOPs, it's upwards of 50,000 rupees and it's expected to increase significantly over the next 2 years going forward. We have several large marquee listed hospital companies in India and we think this sector is going to do really well. I'm just going to take one last slide before I wrap up this presentation. That's on the financial side. I think the financial inclusion thesis in India is actually likely to play out materially over the next 6 months to a year, largely because of the repo rate cut transmission that has happened. We think it's going to get transmitted much faster through banks, while on the NBFC side, the rate cut transmission doesn't happen at the same pace. So we think today, keeping aside all the asset quality issues that they're seeing, they're going to see a much faster growth as compared to banks. But we urge you to look at a lot of players outside the NBFCs and the banks, which are the insurance company, the capital market players, as well as the other players who are associated with this whole ecosystem, where a lot of investment opportunities are going to come up to. So that's about it. Thank you so much everyone for listening to me.